Hi everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is a show where we get you a lowdown on everything related to your money and your personal finances. Today we will be talking about a topic we haven't touched in a long time, and that is taxation. Yes, FM Sitharaman has granted that extension when it came to tax saving investments. However, the new financial year has started from the 1st of April, so there's another decision that has to be made. Which tax regime do you want to be in? The existing one, wherein you're taxed at either 5%, 20% or 30%, or the new option that FM Sitharaman gave when she announced Budget 2020 back in Feb, where she allowed for a new tax regime with lower rates. However, the rider is that you will not be allowed to claim any of the tax investments you make or even some of the deductions. But mind you, compliances will be lower. So now the point is that everybody needs to make the decision right now, especially if you're salaried. If you're salaried, you need to inform your employer which tax regime do you want to be in, because your employer will accordingly deduct TDS for the rest of the financial year. So it's extremely important for you to do that. The CBDT as well came out with a clarification saying as much, that you need to inform your employer about which regime you want to be in. So I have with me Mr. Ved Jain, past president of the Institute of Chartered Accountants of India, the ICAI, joining me today on the show. Mr. Jain, really appreciate you giving us your time today on ET Now. This is quite an important matter as well about the communication of the tax regime. We've not had to do this before. Many of us are doing it for the very first time because, you know, this sort of a policy has never been brought about before, where the taxpayer is given an option. What's the tax that you want to pay? So, Mr. Jain, very simply put, how can taxpayers, what are the factors that taxpayers should consider before they decide that they want to be in the existing regime or the new regime?
Minister has given two options. If you want to save, then you choose the old option. If you don't want to save, go for the new option. She said in the budget that there are more than 100 deduction and exemptions available under the various provisions of the Income Tax Act, and I want to do away. And she has made a beginning by doing away 70 deduction and exemption and have lowered the tax rate for that purpose. So she has reduced the tax rates in the bracket from 5 lakh to 15 lakh. As we all know, from 5 to 10 lakh, the rate is 20%. She has staggered is 10%, 15%. And between 10 lakh to 15 lakh, the rate is 30%, which she has staggered to 20 and 25%. So that concession she has given. And one way she has given the concession has withdrawn another concession of deduction exemption. So in case you are making saving and you have a salaried employees and you have a deduction on account of tender deduction, other deduction, then probably this new regime may not suit. But yes, there are people who want to spend and who don't have the money to save. For them, I believe the new option is a better option. And as you rightly said, the board CBDT has just clarified, yes, you need to give the option to the employer in the beginning of the year itself. And once you have given an option, it will be one-time options, and you need not withdraw. You can withdraw it. But you still will have an opportunity to change your option at the time of filing your tax return, which will happen in your case in July 2021. So that option is available. But I need to just clarify that once you choose the new option, this option is for year-to-year basis for salaried employees. But for business and other people, it will be one-time option. Once you choose, it has to go for all the years to come. As a salaried employee, there are many deductions. As I say, standard deduction will go, HRA deduction will go, and similarly ATC, which you make or long-term saving on account of PF, PPF, or life insurance premium, all those will go. In terms of housing loan, that exemption will also go. So those are all these exemptions which will go. And one need to carefully evaluate the deduction and exemption which one is entitled to, even otherwise without saving, whether the tax after those deduction and exemption is more than the tax which he would pay otherwise if he chooses to the new tax rate. As I said, the tax rate from 5 to 7.5 lakh has been reduced to 10%. And from 7.5 lakh to 10 lakh, it has been reduced to 15% as against 20%. And from 10 lakh to 12.5 lakh, it has been reduced to 20% and as against 30%. And from 12.5 lakh to 15 lakh, it has been reduced to 25%. Beyond 15 lakh, the tax rate continues to be 30%. So these are the broader parameters one need to look into and work it out.
Just to clarify it again, Mr. Jain, I know you mentioned already about HRA. I just want to clarify, there are sometimes food coupons that employers give. There's LTA as well that employers give. Those also will not be allowed as deductions in the new regime?
All perquisites will go, except those allowances which are given by the employer to discharge the official duties, which are the conveyance allowance if you get it for discharging a duty, for going from office somewhere place. If you need to travel from one place to another place for business duty, those type of allowances will be, I think, will be kept. A notification is still to come on those allowances, but all other exemptions which you have given, the lunch coupon or other coupons, all will go. All the deduction will go.
Okay, all right. Now, Mr. Jain, we're speaking to you when the month of May has already come in. So that means a lot of employers have already paid their salaries to employees. I just want to understand, what if the employee has explicitly not mentioned which regime he or she wants to be in? In such a scenario, can an employer just assume that, okay, this individual wants to stay in the old regime?
Yes. The CBDT circular say those employees who intend to opt for it, they need to make they write a letter or a formal application to the employer, giving their choice that they intend to go to the new regime, and they have made it very explicitly clear. Once you submit this letter, then this letter cannot be withdrawn during the year. So I believe that yes, in case you don't give this letter in the first month or the second month, then you will not be in a position. But I am of the view that in case you have not given in the first month, it doesn't mean that it has to be given in 30th April only. The moment you give it, from that day onward, it will be applicable that yes, you want to shift to the new regime. So till such time you exercise the option, you will have the right, I think, to submit. But once you have exercised the option to the employer, then you will not be in a position to retain.
Okay, all right. But again, just a reminder to all our viewers, at the end of the year, when you are filing your return, Mr. Jain as well did mention this. I'll just, restate it for the benefit of our viewers joining in. Let's say if you have decided at the beginning of the financial year that, look, I want to stay with the old regime, I don't think the new regime suits me, that's fine. Your employer will deduct TDS accordingly. However, by the end of the year, if you have changed your mind, at the time of filing your return, which will be around July 2021, you can change over to the new regime, and then of course whatever balance amount of taxation, either payable or refundable, that's something that you will of course have to ensure that you do try to make it before the 31st of March, otherwise there will be an interest element and it will come under SA tax. So that's extremely important to understand. Okay. Mr. Jain, I wanted to ask you about essentially an important point that has now come about, especially because we're in the midst of the COVID lockdown, and that is, the budget 2020's proposal with respect to the number of days of stay in India by an NRI, by an individual rather, to be classified as a resident or a non-resident. Now, obviously, given the fact that we're in the lockdown, a lot of individuals have had to extend their stay in India, which means that they may not be meeting the criteria to be classified as non-resident. So they're staying in India for more than 120 days because of extenuating circumstances. But has there been any communication from the IT department that, because of the lockdown, we'll let that one go and we'll still classify you as NRI?
I see till such time there is no clarification. There are two changes which one should notice. Earlier, the period of 182 days was applicable to Indian citizen and person of Indian origin to be a resident and become a resident. The Finance Act had changed this from 182 days to 120 days, subject to the condition that your total income exceed rupees 15 lakh in India. That's the one condition. Now, we are in the lockdown period from 24th March, and there are maybe many non-residents who have been working in UAE, etc. And they may come to India and their period of stay may get extended beyond 120 days, and their income in India may get more than 15 lakh. Or there may be people who may have period extended to 182 days or more. The challenge will come up. So far the CBDT has not clarified and CBDT has not come with a concession to exclude this period, which we call a forced stay in India. That's the issue. But I may remind that there are a few judgments earlier. One is of the Delhi High Court in the case of Sanjeev Nanda, where this issue has come up, where a person's passport was impounded by the authorities, and he was forced to stay back in India for a period exceeding the days prescribed, 182 days at that time. And the court then has taken a view to know that period, which is a forced stay period, should be excluded. So I am reasonably confident the way the time has been extended, this time also the CBDT will come with some clarification on that issue. He's saying, yes, this period where your period of forced stay should be excluded. And more so, you will recall now yesterday, the government has taken a call by calling many UAE residents who are Indian citizens. They are coming back to India and going to Kerala. I hope you are aware of this. And now these people will be staying in India, and which I believe is forced stay will be there. So that's why I am still hopeful that CBDT may come with a clarification and yes, say yes, this period need to be extended. We need to wait and watch till such time the notification comes. It may not be. One cannot assume it that period can extend.
Oh yes, there are various flights that are being organized by the Indian government, by Air India, to bring back Indians that are residing abroad. In UAE, Maldives was the latest that I had read, that they're bringing them back to India over the next couple of days. So yes, there is a possibility that there may be some exclusion of the days that you had to live in India because of the lockdown. But mind you folks, there's nothing clear yet. There's no clarification yet from the department. As and when they comes, we on the Money Show will obviously let you know about the same. All right. The other topic I want to talk to you about is, there was a circular that was doing the rounds just sometime about 10 days ago, and that said that the IT department actually recommended some sort of a COVID tax on the super rich. I mean, what's the truth to that? If you could just clarify that for our viewers.
Circular, there was some enthusiastic IRS officers which have come out with a plan and giving suo motu suggestion to the government that there should be a COVID tax on the high net worth individual or the super rich, which you call it. Looking to the present scenario, Indian economic scenario in the tax rate, I am of the view that it is not advisable to have such type of a tax rate, etc. As you will recall, we are already having a 37% surcharge on an income of exceeding 5 crore rupees, which are HNI, and there the effective tax rate goes beyond 42%. And to levy tax on individual beyond 42% to go 37% surcharge, you may call it a surcharge simple. It is a COVID tax in a way. So what more you want for the super rich? And more so, when the economy is not in good shape and we need to revive the economy, and these are the HNI and the high net worth individual or super rich which are going to put in and pitch in and to revive the economy. So I don't feel, and I am not of the view that the government will come out with such tax, what we call a super rich tax, etc. And we see recently the government has already raised alternative resources by increasing the excise and the surcharge on the petrol and the diesel. So I believe that whatever is the extra expenditure and whatever is coming out, and because of the lower economy's collection in the taxes, probably will get realized more so from this other taxes. I don't think any scope of raising any tax on in direct taxes, that's the income tax, etc.
Okay, all right. Again, nothing from the government yet. And according to Mr. Jain, that will not prove to be very good for the economy, very detrimental. Any sort of tax increase at this point of time should be avoided. Well, we'll take on board some questions and queries. And folks, if you need some advice on what sort of tax regime should you opt for, and you need to communicate your decision to your employer or to anybody, you can email us right now on the Money Show at etnow.tv, and we can get your questions answered by Mr. Ved Jain. Let's take on board our very first query. Rahul Kaparia has emailed us saying, I'm holding the Mirae Asset Emerging Blue Chip Fund via an SIP. If I switch some amount from the Mirae Asset Emerging Blue Chip Fund to Mirae Asset Tax Saver Fund, Shall I claim that amount under Section 80C in income tax for FY21? Okay, very interesting query. He wants to move the same amount over to a tax saver fund. Would Mr. Jain, would that comply as making an investment under which you can claim 80C deduction?
See, law is very simple and clear. Whatever amount you invest during the year in an eligible scheme, you can claim deduction under Section 80C. The law does not require from where the money came in. Before 1998, there used to be a provision where used to say that the money should be invested out of the current year income. Now there is no such law. The amendment was made long time, 20 years back. Now, in case this Rahul encashes his old investment, which he has made in one of the premium scheme of the mutual fund, etc., and that money get invested into the another scheme, which is a tax saver scheme and eligible for 80C, he will be fully entitled and eligible to claim exemption and deduction under Section 80C, because the new scheme is an eligible scheme. Investment has been made during the year, and the law does not require from where the money has come.
All right. So simply moving funds from one kind of mutual fund to a tax saving mutual fund will suffice the purpose of being eligible for an 80C deduction. It does not necessarily mean that the money has to come from your bank account. It just has to you don't need to really have a particular source from where that money has come. As long as you are investing in your name in a tax saver fund, that will be more than enough. Rahul, I hope that question has been answered for you. You will be able to claim this under Section 80C for FY21. MC Muthaya from Chennai writes into us saying, my wife and I have been regularly investing in equities for the last 25 years. Portfolio is in joint name right from day one. All these shares were acquired while they were NRIs living outside of India, and they were made through joint NRE accounts. Then in 2011, they came back to India for good, moved their NRE PINs and non-PINs portfolio to residential demat accounts. Now, currently, they're getting roughly $500,000 every year as dividend income from this portfolio. Despite having filled tax returns regularly by both of us, dividend income and LTCG from this account has been declared as only my income in ITR because they were exempted and they were tax-free income. But, of course, then we did have Arun Jaitley's budget saying that LTCG will now be taxed if it's more than 1 lakh rupees per year. And furthermore, now FM Sitaraman has also caused dividend income to be taxed from the 1st of April 2020. So now his question is it advisable now to split up the portfolio and not have a joint account? Mr. Jain?
Very interesting questions and very difficult answer on that purpose. Look at the act. You see, the law clearly says income is to be assessed in the hand of the person who has earned that. And there is another strict law which says in case you transfer money to your spouse without consideration, income arising from that money which you have transferred is to be assessed in your hand, not in the hand of the spouse. Now, in the case of this gentleman, he and his wife both were working and both have earned the money. They don't have kept a separate account, and normal is that way. And till such time the income was exempt, nobody bothered, and this gentleman continued to show the entire investment, dividend income, long-term capital gain in his hand as his own income. Now, since both these income have become taxable, now we want to split it. And for splitting it, it is not so simple to divide 1 by 2, 50% to me and 50% to the spouse. What he need to do is need to go back to 2011 period, find out who has earned the money in the joint bank account, whether she has put in the money or he has put in the money, and complete track down from 2011 till date to whom this investment belong and how he divide. That's some rational formula need to be worked out on the basis of the money which has been earned each one of them. And on that basis, the income has to be divided, whether it is a capital gain or a dividend which is coming from investment. So he need to prepare, I believe, some sort of accounts starting from the beginning. And so the statement of affairs can be prepared of the wife and the husband both, and then tax can be computed. It's not so simple, I will say, the answer will. Because there is a section 64 which puts a restriction on such type of splitting.
Wrap?
Yeah. I believe I have answered this question, clear? I could not get your voice.
It's not going to be so easy. You can't just simply split it. It's not going to be so easy. It will require a lot of calculations. So unless your amounts are extremely big, you could consider just simply skipping it, or else if your amounts are really big, then yes, you'll have to go through all of the effort. You will have to ensure there's some rationale behind splitting it, etc. Okay, you know what, we're going to take a very quick break right around the show. Do come right back.